Right now, as we watch the market pulse in real time, shares of the Coca-Cola Company trading under the ticker symbol KO on the New York Stock Exchange are changing hands at exactly $72.95. That represents a significant intraday surge of $1.74, translating to a gain of 2.44% on the day. For a massive blue-chip conglomerate like Coca-Cola, a move of nearly 2.5% in a single trading session is enormous. This isn't a volatile cryptocurrency or a small-cap biotech firm. This is a company with a market capitalization that rivals the GDP of some nations. When a stock this heavy moves this quickly, it signals that something substantial is shifting beneath the surface of the broader market. The expectation for a company like Coca-Cola is that it functions almost like a bond substitute, a slow, steady vehicle that barely moves, pays its dividend, and preserves capital. The reality we are witnessing today, however, is drastically different. The reality is that Coca-Cola is currently acting as a high-momentum asset, aggressively outperforming the broader indices and attracting a wave of capital that seems to be fleeing from somewhere else. This creates a fascinating tension. Why is the market suddenly rushing into a century-old beverage company with such urgency? The answer lies not just in the soda itself, but in the defensive rotation we are seeing play out across the entire financial landscape. When you look at the price action today, the first thing that jumps out is the sheer volume supporting this move. We are seeing institutional-grade buying pressure that kicked in right from the opening bell. Usually, retail traders on platforms like the Robinhood app or those engaging in SoFi investing might chase a stock because of a news headline or a viral rumor. But the price ladder we are seeing on Coca-Cola today is too structured, too deliberate to be just scattered retail enthusiasm. This has the fingerprints of large-scale reallocation. It appears that fund managers are actively reducing exposure to high-beta growth names. Think of the volatility we often see in Tesla stock or the cyclicality that affects Nvidia stock, and are parking that capital into what they perceive as an impenetrable fortress of cash flow. This rotation is the key narrative of the day. Investors are waking up to the fact that while technology offers growth, it also brings massive variance that can wreck a portfolio during uncertain economic times. By contrast, Coca-Cola offers pricing power that is virtually unmatched. When inflation hits, tech companies struggle with rising borrowing costs, but Coca-Cola simply raises the price of a can of soda by a few cents, and consumers continue to buy it. This ability to pass costs on to the consumer without destroying demand is the moat that Warren Buffett always talks about. And it is the primary reason we are seeing the stock push toward these new highs today. If we look at the technicals, breaking through the $72 level is technically significant. For weeks, this area acted as a ceiling, a resistance point where sellers would step in and cap the upside. Today, that ceiling has been shattered. The price action suggests that short sellers who were betting on a pullback are being forced to cover their positions, adding more fuel to the fire. This is a classic breakout scenario. Whether you're a self-directed trader using Interactive Brokers trading setups with complex limit orders, or someone who simply uses Schwab Intelligent Portfolios for a more hands-off approach, the signal is the same. The path of least resistance for Coca-Cola is currently higher. The stock is ignoring the gravity that seems to be pulling down other sectors, establishing itself as a leader in a market that is otherwise struggling to find direction. It is also worth noting how accessible this trade has become for the average individual. Years ago, participating in a blue-chip rally like this required a dedicated stockbroker and high commissions. Today, the landscape of online investment has democratized this process entirely. You have millions of younger investors using Robinhood fractional shares to buy just $10 or $20 worth of Coca-Cola, effectively piggybacking on the moves made by billion-dollar hedge funds. This layer of retail support acts as a floor for the stock. Even when the institutions pause their buying, the constant inflow from investing sites and automated contributions into Fidelity IRAs or SoFi robo-advisor accounts creates a steady, relentless bid under the stock price. The structural change in the market, the rise of self-investing, and the ease of invest online platforms has reduced the volatility of these large-cap stocks because the ownership base is now wider and more diverse than ever before. But let's step back from the intraday charts and look at the company itself, because the why behind this move is just as important as the how. The common misconception about Coca-Cola is that it's just a soda company struggling against a world that wants to be healthier. That is the expectation that volume should be declining as people switch to water. The reality is that Coca-Cola is barely a soda company anymore. It is a total beverage company. They realized years ago that they needed to own every liquid you might want to drink from the moment you wake up until you go to sleep. They own the water you drink, Dasani, Smart Water, the juice you give your kids, Minute Maid, the coffee you grab in the morning, Costa Coffee, the sports drink you take to the gym, Body Armor, Powerade, and the tea you drink at lunch, Gold Peak or Fuse. They have even aggressively entered the alcohol market with ready-to-drink cocktails, partnering with other giants to produce Jack Daniel's and Coke in a can. This diversification is why the bearish thesis on sugar consumption rarely dents the stock price. If you stop drinking Coke and switch to sparkling water, you're likely just moving from one Coca-Cola product to another. They capture the customer regardless of the trend. The business model is also brilliant in its efficiency. Coca-Cola, the parent company, primarily sells concentrate and syrup. They don't own all the trucks or the bottling plants. Those are owned by independent bottling partners around the world. This is what we call an asset-light model. Coca-Cola makes the syrup, which has incredibly high profit margins, and sells it to the bottlers, who bear the heavy capital costs of manufacturing and distribution. This allows Coca-Cola to generate massive amounts of free cash flow, which they then return to shareholders. This is why Fidelity mutual funds and income-focused portfolios love this stock. It's a cash printing machine that requires very little capital reinvestment compared to a company like Tesla stock, which has to build massive factories to grow. Furthermore, we need to look at the global picture. While growth in North America is steady, the real explosion is happening in emerging markets. In places like India, Latin America, and parts of Africa, the per capita consumption of commercial beverages is still a fraction of what it is in the United States. As the middle class in these regions expands and disposable income rises, the first luxury many people reach for is a cold beverage. Coca-Cola has spent decades building the distribution infrastructure in these countries. Sometimes the only trucks that can reach a remote village are Coca-Cola trucks. This distribution network is an unassailable competitive advantage. No competitor, not even Pepsi, has the same global reach and depth of penetration. The market is also rewarding Coca-Cola today for its resilience against currency headwinds. For a global company, a strong US dollar is usually bad news because it makes overseas earnings look smaller when converted back to dollars. However, Coca-Cola has managed to hedge this risk effectively and use its pricing power in local markets to offset the currency hit. When a company can report strong earnings growth despite currency challenges and high inflation, it signals to the market that management is executing at an elite level. This competence is what investors are paying a premium for today. I want to pause here and get a sense of where you stand on this analysis. For the long-term holders out there, or even the traders watching this breakout, comment below how many shares of Coca-Cola you currently hold, or if you are considering moving capital from tech stocks into staples like KO right now. Do you think this defensive rotation is just a temporary blip, or are we settling in for a longer period where value stocks outperform growth? Continuing with the analysis, we must consider the role of investment help and advisory services in driving this stock. Many Fidelity Wealth Management Advisors and Schwab Intelligent Portfolios algorithms are programmed to reduce risk when market volatility spikes. As the VIX, the fear index, rises, these automated systems and human advisors naturally rotate client funds out of high-risk assets and into dividend kings like Coca-Cola. Coca-Cola has raised its dividend for over 60 consecutive years. In the world of investment, that kind of track record is the gold standard. It provides a mathematical floor to the stock price because as the price drops, the dividend yield effectively rises, attracting income investors who step in to buy. This creates a self-correcting mechanism that prevents the stock from crashing as hard as the broader market during downturns. Let's look at the comparison to other popular retail stocks again. If you are holding Apple stock, you're worried about iPhone sales in China and supply chain issues. If you're holding Tesla stock, you're worried about margins on electric